Hey everybody, this is Dale Anderson from Fabric Property Group. I hope you're keeping well. So I just wanted to update you on the latest rental reports, which has been provided to us by Zoopla for March 2023. Just going to share screen. So as you can see, the prices have gone up recently by 11.1%. Well, that's the annual rate of rental inflation. So while we're seeing a cooling in the housing market, we are seeing the opposite with the rental market at plus 11.1% annual rental inflation for new lets in the UK. Rental demand is relative to the 5-year average at plus 51% and plus 1% increase in the number of private rented homes from 2016 to 2021. So the summary, rental inflation has slowed to 11.1% from a high of 12.3% in mid-2022. A strong labour market and record immigration drove demand in 2022. Private rented housing supply has grown just 1% since 2016. Higher mortgage rates have further weakened the economics of investing for landlords, impacting the new investment into rental supply. So landlords searching for yields to offset rising costs will push some to let into different sectors of the private rental market. And then the growth in overall rental supply is set to remain limited in 2023. Demand is expected to remain above average but lower than 2022. The final point is rental inflation for new lets will slow to 4 to 5% by the year end. The slowdown could be rapid in inner London and other city centres. So according to Richard Donnell, Executive Director, the demand for renting was incredibly strong in 2022, helping push rents up by 11%. Rents will continue to rise over 2023, but at a slower rate as demand moderates and affordability pressures start to bite harder on renters. As you can see, there's a chart showing the demand continues to outpace supply of homes to rent. So rental market's running very hot, 10% demand for rented homes versus a year ago. The residential rental market has been running hot for 2 years, with something of a perpetual boom in residential rents, which continue to run well ahead of earnings growth. Average rents for new lets have increased by 11.1% in the last 12 months, while earnings had increased by 6.7%. So rental inflation has slowed slightly from 12.3% in mid-2022, but there's no sign of imminent slowdown. Rents have risen by 20% in 3 years and an extra £2,220 a year, which is an ongoing concern for renters, especially those on lower income brackets and or in receipt of housing benefit. Of course, with the cost of living crisis and inflation, this doesn't help. So this report takes a detailed look beneath the headlines into what's driving the boom in the rental market and demand and why we're not seeing a supply side response. The key questions are: number one, when will we see rental growth slow down? And number two, is there risk the rapid rise in rents means landlords overshoot and need to recorrect in the future? So as you can see from the chart, here we show in the purple line rental demand per rental listing and then rental demand per agent branch as we go up into February 2023, as there's a peak there and then it has come down slightly. So rental demand accelerates from mid-2021. Demand for rented homes and rental inflation took off as the economy reopened in the spring of 2021 and new visa rules attracted a major inflow of students and others for work. A core measure of rental demand, inquiries received per state agency branch, peaked in summer 2022 at double the 5-year average. However, with the third fewer homes available for rent than normal, demand per available rental home spiked even higher last year by 250% above the 5-year average. Demand for rental homes remains 10% higher than this time last year, so rents will continue to rise ahead of income unless we see a sustained increase in rent supply or material weakening in demand, both of which appears unlikely at this stage. So there's high economic immigration, which has boosted rental demand. The underlying driver of rental demand is the strength of the jobs market, which has been strong and where there are over 1 million vacancies, according to the latest Office of National Statistics data. 500k record high net immigration of people into the UK in 2022. So many jobs are filled by UK nationals, but the world's advanced economies are increasingly looking to immigration to fill jobs, particularly high-skilled workers. In early 2021, the UK government conducted a major shake-up of visa rules to attract skilled talent. This was one of the drivers of record high net immigration, totaling 504,000 people in the year to June 2022. So this was further boosted by humanitarian schemes supporting Ukrainians fleeing the war and a specific visa scheme for British overseas citizens looking to leave Hong Kong and move back to the UK. There's been a rapid growth in overseas students, which adds to demand. A jump in student numbers also boosted migration. Overseas students studying in the UK totaled 680,000 in 2021, up 122,000 in 2 years thanks to new visa rules. This group of lucrative market for universities and part of the strategy to attract talent to the UK universities, which are some of the best in the world. All university towns have sizable amounts of purpose-built student accommodation. There's a widely reported supply-demand imbalance for PBSA due to the growth in student numbers. This means student demand will spill over in the wider rental market, boosting rental demand in the summer months, which is particularly strong in 2022 as international borders continue to reopen. This explains why rental inflation has remained strong across major UK cities. The other point is supply of private rented homes remains broadly static. While demand has increased, the numbers of privately rented homes remains largely static. In 2021, there were 5.5 million private rented homes in the UK, slightly more than 5.4 million total in 2016. This follows a doubling in the number of private rented homes between 2002 and 2015, driven by landlords using buy-to-let mortgages. So in simple terms, a static supply of rented housing means new investment that adds to supply is offset by property leaving the sector as landlords dispose of rented homes as part of an ongoing portfolio rationalization or the exit of the rental market altogether. We're registering a slight slowdown in landlord sales in the face of a weaker sales market. Some 11% of homes listed for sale on Zoopla in early 2023 were formerly rented. This is a reduction from over 13% last year, but levels remain above average. So also tax changes, growing regulation, higher borrowing costs are leading many private landlords to review their portfolios and the pros and the cons of investing in the housing market. So the economics of being a private landlord has changed. The equity needed to buy new rented homes with the mortgage has increased in recent years as a result of rising house prices, lower rental yields, and tighter lending criteria. This has been exaggerated over the last 6 months by rising mortgage costs. Buy-to-let mortgages are generally interest only. Lenders require the rental income generated by property to be at least 125% of the mortgage interest payments for lower rate taxpayers. So this increases to 145% for the higher rate taxpayers, reflecting tax changes made in 2016. So today the banks are stress testing the affordability of new buy-to-let loans using a stress rate of 6% compared to 4.5% a year ago. You can see the chart below here shows the amount of equity needed to buy a typical rented home for a high rate taxpayer and how higher mortgage rates have pushed this higher over the last year. It will be a similar profile for lower rate taxpayers, albeit at lower values. London, Southeast, Eastern, Southwest, East Midlands, West Midlands, and then you've got Q1 2023 versus Q1 2022. In London, the equity you needed to invest has jumped from £129,000 to £257,000, or 50% of the property. This is a sizable deposit to buy a property, delivering a gross rental yield of just 4%. The level of equity to buy remains lower in regional markets where rental yields are higher. The changing economics of buy-to-let, taken together with rising costs, more regulation, and the uncertain outlook for property values, is severely limiting the level of new investment for private landlords. Some landlords are shifting portfolios into limited companies to find tax efficiencies, but this isn't an option for all landlords. Those that continue to invest will be focusing on buying lower value homes with higher rental yields or looking at segments of the rental market that do deliver higher revenues and strong cash flow potential. So new investment focused on revenue and yield. If you look at the illustration, HMOs, long let housing benefits, long let market rents, holiday and short-term lets, in terms of estimates using multiple government and other sources. So that's how the private rental market breaks down by subsector nationally. This profile will vary widely at a local event. So 48% proportion of rented homes available on long let at market rents. So the key takeaways of the map is that 1 million homes are not available on the open market. They are rented as part of a job or let under secure long-term tenancies. We estimate 8% of rented homes are operating in the holiday short-term let sector where revenues are higher, but so are running costs are concentrated in cities on tourist hotspots. There's a risk that the availability of homes for rent in the long let market will be squeezed if landlords shift into the sector for better returns. Number 3, you've got HMOs, your house with multiple occupation or single dwellings where people rent a room and share the facilities. These are subject to local licensing schemes and incur high management costs, but revenues and yields are higher than a typical buy-to-let. The core private rent sector is the long let market where renters pay an open market rent and take initial tenancies of 6 to 12 months. So rental yields are lower in the segment, but it delivers almost half of all rental supply. Within the long-let markets, 25% of renters are in receipt of housing benefit. Rents are set by the government at the low end of the market and have been frozen since 2020. Yields are similar to the open market, assuming landlords buy lower value homes. So landlords facing costs and regulatory pressures and some choices other than selling. In most cases, planning permission is not required to change between segments. In a sector where overall supply is static, small shifts within these segments can compound supply side pressures, especially in the local markets. So there's been a 20% annual rental inflation in London Borough of Newham, so variations in available supply by type of area. The availability of homes for rent is worse in London, where there's huge competition from a range of renters, including students, those working in the city, commuter belts, short-term visitors. London also has the lowest rental yields in the UK as well. We've shown how much equity is needed by private landlords to invest in the market, which limits the flow of new supply to improve availability. The net result means London tops the league table for rental inflation at 15.2%. Supply has improved in tourist areas, which are out of season at present. This might also reflect more supply that was holiday short-term lets in the long-let market, or as the staycation boom slows. Available rental supply has also improved in major UK cities, the largest 11 excluding London. So if we check the chart, rental supply across different market segments, you've got your tourist areas excluding London, you've got major UK cities, and then you've got the rest of the UK. A risk of rents overshooting. There is a low supply, which could exaggerate rental growth in local areas where rents for new lets have jumped the most. So there's a risk that rents may overshoot sustainable levels. If rents get so high that many existing renters in areas simply couldn't afford them and demand would cool or supply improve, the rental level would need to reset lower. This would result in a sharp slowdown in growth rates. The greatest risk is in inner London, where affordability has been stretched. So there's been 4 to 5% rental inflation at the end of 2023. Rental growth varies for new lets versus all rented homes. There's a difference between the pace at which rents are rising for new lets when a property becomes vacant and the rent resets to the market rate, and how much rents are rising across the whole rental sector, whether people are moving or not. So both matters to renters as they impact the decision whether to move to a new property or how much the landlord might increase the rent after the initial term. Outlook will start to be shaped by affordability, I believe. So we expect a continued scarcity of homes for rent over 2023. Given the weaker economics for investors, ongoing completions of build-to-rent schemes will be in the spotlight, adding supply at the mid to upper end of the market across UK cities. So one additional area of potential supply could come from sellers renting out homes they can't sell due to a weak sales market. Conditions aren't sufficiently challenging at this stage for this to impact the outlook. We believe rental demand is unlikely to be quite as strong as last year, given weaker economic growth, but we do expect it to remain above the 5-year average. Much depends on trends in employment, especially across UK cities where rented homes and jobs are concentrated. In terms of affordability, average rents expressed as a percentage of earnings are now at or close to 10-year highs in all regions except for London. This will start to impact the pace of rental growth over 2023, which we expect to slow to 4 to 5% by the end of the year. As you can see here, we'll just quickly take you through the chart. And there you've got the different areas, year-on-year rental inflation. Northwest, we've got properties there, Yorkshire, Northeast. So there's some really good areas there that we can provide investment property that will provide you above average rental yields. There's clearly a lack of supply of good quality rental accommodation coming to the market in many of these cities. So that's something we could certainly help you with, and you can benefit from the increase in the rents that's happening in the market today. So I won't go into too much more detail. I hope that you find this useful. Again, my name is Dale Anderson from Fabric Property Group. I'm the managing director. I've been in the industry now for almost 2 decades. Subscribe to my newsletter. There's a lot more information we provide to keep you up to date on the market. Take care and all the best.